Bitcoin has been one of the best performing assets in recent years, and as its popularity and price continue to grow, more investors are looking for how to get involved. For US investors, the most popular way to do this within traditional markets, judging by assets under management, is with the Grayscale Bitcoin Trust, ticker GBTC. However, I'm here to tell you why this is potentially the worst way to buy and own Bitcoin. Now, I'll give credit where credit is due, because the convenience of the Bitcoin Trust is definitely worth noting. Unfortunately, I believe the drawbacks of GBTC far outweigh the convenience it offers. Specifically, we're going to talk about the management fees and the structure of the fund. The combination of these two problems means that GBTC investors are historically paying more to own Bitcoin while also getting lower returns, at least compared to buying it directly themselves. Because of this, there's only one specific scenario where I think GBTC makes any sense whatsoever, and that would be within a retirement account. But even then, I'll show you why the numbers don't quite add up. To wrap things up, I'll offer a few better options for investing in Bitcoin, including some within traditional markets. So let's take a look. First, we need to understand the structure of the Grayscale Bitcoin Trust and the convenience that it offers. To put it simply, GBTC gathers money from investors, uses it to purchase Bitcoin, and then issues shares to investors that represent a portion of the fund's Bitcoin holdings. According to their latest SEC filings, the Grayscale Bitcoin Trust held a total of 654,600 Bitcoin, with a total of about 692 million shares. This means that each share of GBTC represents approximately 0.0009 Bitcoin. However, a very important characteristic to understand about GBTC is that it operates as a closed-end fund, which differs substantially from typical ETFs and investment funds. Many investment funds are open to new investors at all times, and as new cash flows into the fund, they'll continue to purchase more of the underlying holdings and create new shares for those new investors. But as a closed-end fund, GBTC has a limited number of shares in circulation and is not always open to new investors. Occasionally, GBTC will open up what they call private placement, which allows accredited investors to buy into the fund, at which point they'll purchase more Bitcoin and issue new shares to those investors. However, to be an accredited investor, you must make significant income and have a net worth of at least $1 million. This means that the average investor can't buy into the fund through Grayscale, but instead must buy shares on the secondary markets via eligible brokerage accounts from the number of outstanding shares that are currently available. Furthermore, Grayscale currently doesn't allow investors to redeem their shares for cash. This is something that many big investment fund providers offer, which allows investors to cash out of their investments at net asset value. With GBTC, however, the only way that investors can currently realize the returns is to sell their shares to someone else on the public market. So with these characteristics, Grayscale has full control over the amount of money flowing in and out of the fund, as well as the amount of Bitcoin they own at a given time. And because the number of available shares is often a fixed supply, new investors have to go to the public market to invest in the fund, where prices will be heavily influenced by demand. Theoretically, more demand for GBTC will drive up the price of the shares, while a drop in demand will decrease the price. So while each share will represent the same amount of Bitcoin, you may be paying more or less for that Bitcoin, depending on the price action of the shares on a given day. In other words, GBTC is not able to perfectly track the price of Bitcoin, which is one of the biggest negatives of the fund and something we'll dig into further in a minute. Even though it's not a perfect solution, GBTC does serve its purpose as a vehicle for gaining direct Bitcoin exposure in traditional markets. For starters, this makes it really convenient for investors to add Bitcoin to their current portfolios. They don't need to create new accounts anywhere because it's available through most brokerages. This means that investors don't need to figure out how to use digital wallets, private keys, sending transactions, and all of the technology surrounding Bitcoin that may be intimidating to those who are new to cryptocurrency. Now, most people in the crypto space will argue not your keys, not your Bitcoin, which certainly has its merits. However, I'm of the opinion that as Bitcoin gets added to more traditional investment vehicles, they'll have to have pretty strong security in place. So from a security and safety perspective, I tend to be pretty trusting of the systems involved, especially in this case, where the custodian of GBTC's Bitcoin portfolio is Coinbase. I think the not your keys argument is more applicable to people who hold and view Bitcoin as a decentralized currency, and is less important for those who simply want to use Bitcoin as a digital gold or alternative investment. Additionally, GBTC simplifies taxes because it keeps everything under one umbrella, so to speak. Instead of juggling capital gains and taxes between brokerage accounts and cryptocurrency exchanges, GBTC keeps your Bitcoin activity nested within your usual accounts where tax documentation is readily available. Finally, GBTC is one of the only ways to hold Bitcoin in a retirement account, which we'll further explore later in this video. So with these benefits, why is GBTC an awful way to buy Bitcoin? It really comes down to two issues, which are the management fees associated with holding GBTC and the fact that investors are almost always paying a premium to own Bitcoin when using this fund. We'll take a closer look at both of these problems. We'll start with the management fees, which come in at 2% annually. This is a cut that Grayscale takes for operating and managing the Bitcoin Trust. According to their SEC filings, the interest accrues daily and is paid out on a monthly basis for the previous month. So how this works is every day at market close, Grayscale will use the market price of Bitcoin to determine the fund's net asset value, or NAV, which is the dollar value of their entire Bitcoin portfolio. Because fees accrue daily, they'll determine the daily rate of a 2% annualized fee, which is approximately 0.0055% of the NAV. They'll let this accrue throughout the month, and when the month is up, they'll sell Bitcoin from the trust to pay themselves that fee. So every month, they are selling some of your Bitcoin to collect that 2% annualized fee. Over time, this means that each share represents less and less Bitcoin. Although management fees are common in investment funds, 2% is extremely steep. And while it may not sound like much, it could cost you tons and tons of money over the long run, especially with an asset like Bitcoin that may be appreciating quite a bit in the coming years. Let's take a look at an example using the fund's previous performance. On March 31st, 2018, one share of GBTC represented about 0.001 Bitcoin. On that date, Bitcoin closed at approximately $6,900, which means your share of GBTC represented about $6.93 of Bitcoin. Over the next few years, Grayscale continued taking 2% of the fund's Bitcoin annually for those management fees. As a result, 3 years later, on March 31st, 2021, one share of GBTC represented about 0.000945 Bitcoin, approximately 6% less Bitcoin than in 2018. And the real cost of these fees becomes apparent when you look at how fast Bitcoin is appreciating. Not only are you losing a portion of your investment every year, but because Bitcoin is such a rapidly appreciating asset, you're also losing potential gains from whatever price Bitcoin could reach in the future. Because of the convenience that GBTC offers, this may be a reasonable compromise to some, but I think 2% is way too high to justify holding this fund. And that brings us to the next big problem with the Grayscale Bitcoin Trust, which is the exorbitant premium that investors are paying to get their hands on Bitcoin in this way. As we covered earlier, due to the structure of the fund, unless you're an accredited investor, the only way to buy into GBTC is on the secondary market. And again, in this scenario, the fixed supply of GBTC shares means that the share price will fluctuate based on demand. So even though one share currently represents about 0.00095 Bitcoin, you might actually pay more or less than the exact dollar value of Bitcoin at the time of your purchase. This premium is measured by the difference in share price and NAV. NAV will represent the dollar value in Bitcoin that you get per share, while the share price is simply what the shares are trading for. Here's a quick example from January 31st, 2020. On this day, shares were trading at $10.82. However, each share represented just $9.05 in Bitcoin value. This is because the amount of Bitcoin per share was constant, but demand for GBTC pushed share prices higher. As a result, investors who purchased on this day paid a premium of nearly 20% to purchase Bitcoin through GBTC. The reason that this is a big problem is that the fund nearly always trades at a premium. According to YCharts, the average premium of GBTC is more than 30%, although there's many timeframes where it's traded at even higher premiums. So historically, GBTC is an incredibly expensive way to buy Bitcoin because you're paying more to own it with GBTC than what it actually costs to buy it outside of traditional markets. If this premium ever diminishes or even goes negative like it has lately, the value of your investment could drop substantially, even if Bitcoin's price manages to stay the same. Just like expense fees, this may be a reasonable compromise for some investors, but combining both 2% annual fees and an average premium of over 30%, I believe the costs of buying into GBTC are going to outweigh any potential benefits or convenience of holding it in a standard brokerage account. Of course, like I said, the one exception might be if you're using GBTC as a way of holding Bitcoin in a retirement account. The benefit here is that in a tax-sheltered retirement account, you will not have to pay any taxes on the capital gains from GBTC, which ideally will be quite high in the future. However, I want to challenge investors to consider the following problems with holding GBTC within a retirement account. First, this doesn't protect you against management fees. You'll still lose 2% of your Bitcoin every year, which can compound to be very expensive over 10, 20, 30 years or more. Second, it still doesn't solve the issue of paying a premium for Bitcoin almost every time you purchase shares. This could be really dangerous if the premium diminishes, which is likely to occur as more Bitcoin funds become available and there's less demand for GBTC. Last, and most importantly, I don't think the tax benefits are sure to make up for these costs. Consider the fact that Bitcoin doesn't pay dividends, so you don't even need to worry about any sort of taxes until it comes time to sell. From this perspective, retirement accounts only provide you the tax protection when you sell Bitcoin, which may be important to traders, but not as much for long-term buy and hold investors. And when you do want to sell, there's two outcomes depending on your retirement account. If it's a pre-tax account like a standard IRA or a 401k, you can sell your Bitcoin tax-free, but you'll still owe income tax on any money you withdraw in retirement. In this case, you'll owe a minimum tax rate of 10%, which will increase depending on how much you're withdrawing. This is still a preferable tax treatment if your income stays under $40,000 a year, but anything above that puts you in the 22% tax bracket. And in these cases, you might as well have bought and held Bitcoin directly in a digital wallet, where you could later sell with a favorable capital gains tax rate, which is likely going to cap out at 15% for most investors, assuming you make less than $400,000 a year. Plus, then your Bitcoin was able to grow without 2% fees, and you didn't have to pay a premium for it. The other outcome is a post-tax account like a Roth IRA. In this case, you can withdraw your Bitcoin returns tax-free thanks to GBTC. And this is the rare scenario where I think you can actually gain some benefits from holding GBTC. The question is, do these benefits outweigh the 2% annual fees and consistent premium you'll be paying to hold it over the years? It's impossible to answer this question with any guarantees because it will ultimately depend on how Bitcoin performs in the coming years. But personally, I think the numbers are against you with the costs of GBTC. So here's what I'm doing instead to secure long-term, tax-efficient growth from Bitcoin. First, like I said, it just makes more sense in many cases to buy Bitcoin directly. It's easier, safer, and cheaper than ever, and you can even earn interest on it to further increase your returns. For example, you can purchase Bitcoin on Coinbase Pro with a one-time 0.5% fee. After purchasing, you can hold your Bitcoin at no cost to you. Or you can even move it to something like BlockFi, where you can earn an extra 5% interest on that Bitcoin. Both Coinbase and BlockFi then provide tax documents that you can easily add to your tax return to accurately report any taxes when the time comes. You're not paying any sort of premium to purchase Bitcoin in these cases, it's not costing you anything to hold it, and it's just a slight inconvenience at tax season, if and when you choose to sell. I'd happily take a gentle 15% tax rate after decades of holding Bitcoin, rather than paying 2% of my Bitcoin every single year in fees and battling against premiums. I mean, think about it this way. If you did a lump sum investment into GBTC with 2% annual fees, after 8 years of paying those fees, your shares would represent 15% less Bitcoin than you started with. Instead, you can buy Bitcoin outside of traditional markets, hold it for at least 8 years, and use all of the money you saved in fees to pay your long-term capital gains tax. If you held GBTC in your retirement account for longer than 8 years, it's going to cost you more in fees than it would to buy and hold Bitcoin outside of traditional markets and simply pay taxes on your capital gains. However, I still see the value in the convenience of a retirement-friendly Bitcoin investment. And to be completely honest, I still want to hold one of these investments in my retirement account, but GBTC isn't it. Fortunately, I think it's the first of many to hit the markets, and as more of these funds are created, competition should lower management fees, and they'll be able to track Bitcoin's price more closely. The first example I have of this is the Overrated Bitcoin Trust, which functions exactly the same as GBTC, but only has a 0.49% management fee. That's already way more attractive than Grayscale's fees, and that's a cost I'm much more comfortable incurring to hold Bitcoin in a retirement account. They are still vulnerable to premium pricing, but that too should decrease as more products come out. Alternatively, a Bitcoin ETF using an open-end fund structure would solve the issue of premiums and may also offer lower fees. These have been highly anticipated for a few years, with multiple applications in the works. It may still take some time for these to come in market, but I think the more Bitcoin proves it's here to stay, the more of these products will start going live. So for now, I like the Overrated Bitcoin Trust for retirement accounts, but I'll probably wait things out a little bit longer and keep buying Bitcoin directly in the meantime. Let me know how you're buying Bitcoin in the comments, especially if you're using an investment product that I didn't mention in this video. Thanks for watching, and I'll see you next week.